SpaceX is executing the largest initial public offering in the history of the stock market. They are raising $75 billion at a strict fixed price of $135 per share. Yet, while initial demand for the offering is reportedly 4 times higher than the available supply, traditional financial analysts running the math calculate its actual worth at roughly half of that asking price. This side-by-side financial comparison illustrates the contradiction. On the left, we see the company's performance last year, $18.7 billion in revenue, coupled with a $4.2 billion operating loss. On the right, we see the IPO asking price, a $1.77 trillion valuation. Despite those deep operating losses, the IPO is heavily oversubscribed. Institutional funds and retail investors alike are aggressively fighting for early allocations, fully willing to pay the premium. This sets up a direct, inevitable collision. Anyone looking to buy into this IPO is forced to navigate between stark mathematical reality and absolute market frenzy. So what is this company actually worth? The answer is entirely subjective, and it depends heavily on which specific financial game you are trying to win. This bar chart lays out the baseline discrepancy. Traditional estimates place the company's intrinsic value somewhere between $42 and $60 a share. The IPO requires you to pay $135 on day one. To make an informed decision, we have to separate our analysis into 2 distinct categories. We must evaluate SpaceX, the company, which runs on long-term business fundamentals, and SPCX, the stock, which runs on short-term market momentum. That is the central trade-off you face. Buying at $135 means willingly surrendering your traditional margin of safety in exchange for a structural advantage in market momentum. Let's start with the value investor. This strategy relies entirely on long-term fundamentals, calculating revenue multiples, studying operating margins, and determining a strict intrinsic value for the business. When we plug SpaceX into that model, the warning lights flash red. You are looking at paying a 90 times revenue multiple for a business that currently burns over $4 billion a year. Paying $135 today means you are pricing in absolutely flawless business execution over the next 5 to 10 years. You are assuming every rocket launches on schedule and every satellite performs perfectly. That creates massive downside risk. If the company faces engineering delays or regulatory hurdles with their orbital goals, the market will aggressively compress that valuation to match reality. Historically, value investors avoid IPOs for this exact reason. They wait for a period called price discovery, the months after the initial hype fades, when the market naturalizes the stock's price based on actual earnings. For a strict value investor, this stock is objectively overvalued. Protecting your capital means sitting this IPO out and waiting to see if the price drops closer to the $60 mark. Now, let's look at the momentum trader. This strategy ignores spreadsheet fundamentals entirely. Instead, it focuses strictly on market mechanics and severe supply and demand imbalances. The primary catalyst here is the stock exchange itself. Major index providers, including the NASDAQ 100 and the Russell 1000, are bending their traditional inclusion rules to fast-track SpaceX into their funds. This timeline tracks the outcome of those rule changes. Over the first 15 days of trading, it triggers a wall of money. Trillions of dollars in passive index funds are mechanically forced to buy SpaceX stock, driving over $20 billion of guaranteed institutional purchasing. Then we add the secondary catalyst. 30% of this IPO is allocated to retail investors, many of them die-hard Elon Musk fans. That creates an artificial floor of holders who will flat-out refuse to sell, restricting the available supply of shares. The trade-off for playing this momentum game is hypervigilance. You have to actively monitor the trade and exit before the forced institutional buying period ends. If you miss that window, you risk a violent gap down in price. But for the momentum trader, current operating losses are secondary to these market physics. The combination of engineered scarcity and forced index inclusion creates a structural tailwind that favors a short-term price increase. Finally, we must look at the visionary approach. High-profile institutional investors like Cathie Wood are ignoring traditional financial metrics in favor of placing a massive, decade-long bet on technological dominance. Their thesis focuses on a future monopoly, one that utilizes orbital infrastructure to control global telecommunications and AI compute power. The hardware required to achieve this is the Starship vehicle. By successfully deploying the next generation of Starlink satellites, Each Starship launch promises a 20 times increase in bandwidth capacity over current rockets. That hardware translates directly to massive scale. It allows the company to build data centers in space, projecting multi-billion-dollar recurring contracts from deep-pocketed tech giants desperate for AI compute power. To play this visionary game, you have to accept extreme portfolio volatility. You are signing up to ignore the spreadsheet math for a decade, while the technology actually matures. Under that specific lens, the $1.77 trillion valuation is completely justified. It is a venture-style bet on a future global monopoly. Returning to the numbers, the real worth of this company is $42 on a fundamental spreadsheet, $135 at the investment bank, and well over $200 on opening week due to market physics. This decision flowchart breaks down your options. Your next move depends entirely on identifying your primary portfolio goal out of these three paths. If you are a traditional value investor or a dividend seeker, your path is clear. Avoid the IPO entirely, keep your capital safe, and wait 6 to 12 months for true price discovery to take hold. If you are a sophisticated trader who understands supply imbalances and index inclusion rules, take the momentum path. Attempt to buy your $135 allocation and sell it shortly after day 15 when the forced buying concludes. And if you are a long-term technological speculator, willing to write a check to Elon Musk's vision, take the final path. Buy the stock, hold it for at least 5 years, and completely ignore the day-to-day volatility. Make your choice based on your actual strategy. Just do not mistake a brilliantly engineered momentum trade for a safe fundamental investment. Know exactly which game you are playing before you click buy.